6 months ago, we told you Germany had walked into the most expensive energy mistake in modern history. $500 billion later, factories are relocating, banks are exposed, and Europe's largest economy has contracted for 2 consecutive years. But the real damage was never the energy crisis itself. It's what the energy crisis triggered next. And that second wave is what almost no one is covering. Quick context for anyone who missed part 1. Germany shut down its nuclear fleet after Fukushima in 2011, replaced it with renewables, which couldn't cover winter demand, filled the gap with Russian gas. Russia invaded Ukraine. Gas supply collapsed. Electricity prices hit $700 per megawatt hour, 14 times the pre-crisis average. That's where part 1 ended. Here's what happened in the 6 months since. Germany's industrial base runs on 3 pillars: chemicals, machinery, and automobiles. All 3 are now restructuring away from German soil. BASF, the world's largest chemical company, has been headquartered in Germany for over 150 years. In 2024, they announced a permanent structural restructuring, not a temporary cost-cutting exercise. Their new major capital investment is going to Louisiana, where industrial energy costs are roughly 1/3 of current German rates. Volkswagen, under financial pressure for the first time in decades, announced the closure of plants inside Germany, a significant shift for a company that had not done so in its modern history. Their public filings cite energy and labor cost competitiveness as central factors. Thyssenkrupp's steel division, one of Europe's most recognized industrial names, is undergoing a restructuring that its own investor communications link directly to energy cost pressures. Now, here's the broader data point worth examining. German industrial output in 2024 reached levels not seen since the mid-2000s. Nearly 2 decades of industrial output growth have been significantly reversed over approximately 36 months. Imagine 2 decades of industrial growth, erased in just 3 years. In Germany, its GDP contracted for 2 consecutive years, a pattern the country had not seen since the early 2000s. This is not projection. This is recorded in official German statistical data. The structural question now isn't whether Germany's industrial base is shrinking. The data confirms it is. The question is how deep the restructuring goes and what it triggers in adjacent sectors. This is the part that hasn't received much public attention yet. German banks hold significant exposure to German industry, corporate lending to manufacturing, commercial real estate in industrial zones, bond portfolios tied to German economic performance. As industrial activity slows and companies restructure, the quality of those loan portfolios comes under pressure. Deutsche Bank, Germany's largest, has been in a prolonged restructuring cycle. Its equity valuation remains well below its pre-2008 levels, a reflection of how markets have priced ongoing structural uncertainty into the institution. But the less discussed risk sits in Germany's regional banking system, the Landesbanken. These institutions hold large portfolios of commercial real estate loans, industrial properties, business parks, manufacturing zones. As companies reduce German footprints, vacancy rates in these properties rise, asset values adjust downward, and loans secured against those assets face increasing stress. Germany's own financial stability assessments have flagged elevated stress in parts of the commercial real estate lending sector. Here's why this matters beyond Germany. European banks hold cross-border exposure to German financial institutions. If you hold a broadly diversified European equity fund, which hundreds of millions of investors globally do through index products, you carry some exposure to this risk, whether you're aware of it or not. This isn't a prediction of collapse. It's a structural risk that's worth understanding before it becomes headline news. You might reasonably ask, why isn't the German government responding more aggressively? The answer lies in a structural constraint that is unique to Germany. Germany's constitutional debt brake, the Schuldenbremse, legally limits federal borrowing to just 0.35% of GDP in normal times. This was designed to prevent fiscal irresponsibility, but in the current context, it also constrains the government's ability to fund large-scale industrial subsidies or crucial energy infrastructure investment. The coalition government collapsed in late 2024. A new government is now navigating this constraint while also managing political pressure from an electorate that is, for the first time in decades, questioning the direction of its economic policy. Public polling in Germany now shows majority support for reconsidering nuclear energy, but the physical infrastructure is largely gone. Reactors were decommissioned, fuel was disposed of. Restarting at a meaningful scale would require years and an investment that the current fiscal framework makes difficult to authorize. Meanwhile, France, which retained its nuclear fleet, now sells electricity at prices roughly half of Germany's industrial rate. The companies leaving Germany are, in several documented cases, expanding in France, the United States, and parts of Eastern Europe, all regions with more competitive energy costs. Germany made a policy decision back in 2011 under conditions of political urgency. The structural consequences of that decision are now visible in the economic data, and the policy tools available to reverse them are genuinely constrained. So where does this trajectory lead? Economists and analysts are broadly working within three frameworks. The first scenario is a managed structural adjustment. Germany transitions from a manufacturing-heavy economy toward a higher services and technology weighting. Industrial output stabilizes at a lower base. It's painful for affected workers and regions, but the broader economy absorbs the shift over a decade. This is currently the base case in most institutional forecasts. The second scenario is accelerated capital outflow. Industrial restructuring moves faster than policy can respond. Tax revenues decline. Pension and social obligations become harder to fund at current levels. Germany requires some form of EU-level financial coordination. Markets then reprice European sovereign and financial risk more broadly. This scenario is not the consensus view, but it is referenced in several institutional risk assessments. The third scenario is policy-driven stabilization. A new government, under sufficient political pressure, finds mechanisms to fast-track energy infrastructure investment, introduces targeted industrial energy subsidies, and stabilizes the manufacturing base. This is difficult within the current fiscal constraints, but not impossible over a 5 to 7 year horizon. Current data, industrial output, GDP trajectory, corporate relocation announcements, is more consistent with the first scenario moving toward the second than with the third. If you manage your own investments, there are three areas worth examining. First, your European equity exposure, specifically the weighting toward German industrials, German financial institutions, and German commercial real estate within any European index or active fund you hold. Second, your global index exposure. European markets represent a significant share of most global equity indices. A sustained German contraction has measurable effects on broader European index performance. And third, currency dynamics. A weakening European industrial base has historically placed downward pressure on the euro relative to other major currencies. That has implications for the real returns of euro-denominated assets for non-European investors. None of this is investment advice. These are structural factors worth factoring into your own research. Germany's situation is the most visible part of a broader European structural story. But France, which made different energy decisions, one that sits inside its banking system, largely unpriced, and is significantly larger than most public analysis has covered. That's the next video. If this breakdown was useful, subscribe. It's the only way YouTube will surface the next one to you. See you there.